Hey Darren, how you doing? This is John. I'm doing a quick little presentation for you here on the option trade we did today. Disregard the date on this video here. It's a PowerPoint presentation from another day. I just wanted to get the title of it right for you. So we're going to buy two OCT 365 corn calls, selling two OCT 380 corn calls for 2.5 cents. So 2.5 cents is essentially our risk on the trade. That is the max you can lose on the downside. So what we've done is really called a ratio spread. But we're going to buy one call and sell two calls above the market. It's a very good way to trade, especially when you have grain, because you have the commodity as well. So what you do in this trade, really the risk lies in two places. One, risk lies in a fixed amount to the downside, and it's fixed to the amount of money we pay for the trade. So this whole lot, by the time we paid, I think 4.25 cents for the 365 calls, and we sold four OCT 380s for about I think one and a half or 1.25. So the whole cost came out to about 2.5 cents, with your fees to be around 3 cents. So that's essentially the risk to the downside. 3 cents. I'm sorry, 3 cents. So this black line here is where our other option kicks in. This will be where we're long the board as of 3 weeks from now. Okay, so if the market falls below 350, we're going to be long corn at that price. Okay, these other lines here represent profit and loss, essentially. Kind of areas that I want you to note. All right. So first, the one thing I want you to look at here is the let's see here. So these lines here that you're seeing that I'm putting my mouse on, these all represent different times of the trade. All right. So it's obviously this is the P&L of the entire position, the theoretical profit and loss of all of the trades combined. All right. So what you want really to have happen here is us to do nothing, have the market rally to 380, and you're going to make 30 cents or 28 cents. The right axis here is what the price of the option or the profit or loss of the option will be on that certain date. Right here is the price of the option. So where they cross, these lines here are where the value of the option spread will be. All right, so again, this is a time play. We're really looking to just let this thing trade for a while. If it goes down a little bit, it can go down. You're not going to lose a ton of money, as you can see. As it rallies, it really depends on when we rally. All right, so when we rally will depend a little bit on, obviously, the value of the spread. So this black line here that my mouse is on, this thin black here, represents today. So today is already passed, so we don't have to worry about that. This little thin black line is where price is, right here at 358. This next line, blue, is the 8th of September, so we'll call that Sunday night. All right. Sunday night, this is where the position will be worth. So if it would rally up to 370 on Sunday night, the position is only going to be profitable by 2 cents. 4 days from that is the 12th. This is the day of the WASD. So the market would rally on the day of the WASD up to like 375. This is about what the position will be worth. Profitable by 6 cents or $600. 4 days from that, on the 16th, if it goes to 375, we right up here about 12 cents, $1,200. If we continue to hold it and the market would rally up into this price point, this is where the P&L will be on expiration. This straight sharp line. So if it would go up and trade up to 380 and die, it's worth 28 cents. If it goes up to 370 and dies, which is right here, your profit will be about 8 cents. If it goes up to 390 and dies, the profit will be about 10 cents. Where you're going to start losing money again is right around 395. And you'll start losing money on the downside up around 366. So we need to see the market rally, but it can go down in the meantime. You won't face any margin pressure. And it can really go up in the meantime. You won't profit a lot, but it won't face a lot of margin pressure either. So again, I'm using this kind of position because you have grain to sell, and I want to start working this thing from the short side, but I don't want to do it at this price. Okay. So again, keep this chart. I'm going to send it to you with the email so you can reference it. But this is essentially a trade buying two OCT 365 calls, selling four OCT 385 calls. What we want is this thing to die anywhere between 375 and 385. You're going to profit real well in 2 weeks, 3 weeks. All right? Hope you have any questions. Let me know if you need me. Bye.